Are you even being realistic with your profits if you're not being considerate of the inflation in your country? Or rather, let's start with ये इन्फ्लेशन असल में होती क्या है और क्यों इसे इन्वेस्टर्स का नाइटमेयर कहते हैं? Stay until the end of this video because we are going to cover what is meant by beating inflation, what are the strategies you could use to fight back against inflation, and what's the way to go when inflation is on the rise? Stock investments, ETFs, or real estate? Hop on board and consider giving us a sub so we could continue making videos on such exciting topics packed with information. So without further ado, let's dive into it. So what really is inflation? Inflation is a long-term effect of the depreciation of an economy or a country. It highly depends on the decisions of central banks and governmental bodies during crises and unexpected situations. An ideal example of such an unexpected event could be the global recession coronavirus gave us. With inflation on board, living costs go up without corresponding increases in investment returns. Consumers or the people of a city end up having less disposable income to buy products and services, be it the food from your favorite restaurant or the basic supply of necessities you survive on. Inflation spares nobody. More recently, inflation in India's retail sector hit a 7-month high of 7.41% in September 2022, the highest level since October 2020. How do you beat inflation? Beating inflation implies earning higher returns on investment than the economy's inflation rate. If the increase in prices of goods and services exceeds the returns you earn on investments, your returns are null and void. Assume you invested 1,000 rupees in an investment that returned 4% the following year. Your investment is now worth 1,040 rupees. On the other hand, the economy's inflation rate is 5.5%. Your return on investment is less than the inflation rate, effectively cancelling out the returns you earned. In other words, higher returns on investment or ROI is the only weapon you'd need to outpace inflation. Gains from investing are null and invalid if inflation eats away at your purchasing power faster than your returns can cover it. Let's have a look at a few options where you could make your investments. Number 1. Investing in shares or stocks. Historically, stock market gains have been an excellent way to beat inflation. Businesses may see increased earnings as a result of pricing increases. The stock market responds positively to better pricing. Even though there may be exceptions, the long-term return on the stock market has always been higher than inflation. Even though historically, stock markets have grown faster than inflation over the long term, they've also been very volatile and have changed a lot in the short term. Two of these years, 2021 and 2022, provide a good illustration. In October of 2021, the Sensex hit 61,000, up from roughly 25,000 rupees. Though this may be the case for the market, individual stocks' performance may vary. Because of this, we can see that the markets rebound over time. Opportunities for gain and loss are about equal. Well-planned and researched stock market investments may help you outpace inflation. Number 2. Equity-based mutual funds. Many investors find it challenging to keep up with the daily movement of specific equities or the market as a whole. They could invest if they look into the equity mutual funds out there and find one that seems to fit their needs and goals. Equity funds can be put into different groups to be used by a wide range of investors. Equity funds may be categorized in several ways, including market size, sector, investing strategy, tax efficiency, etc. The average 5 and 10-year return on equity funds has stayed over 10%. Number 3. Exchange-traded funds or ETFs. Exchange-traded funds or ETFs are a kind of mutual fund, replicating the performance of bigger market indices like the Nifty or Nasdaq. The cost ratios of ETFs often fall below 0.5%, providing more diversification. The large cap companies that make up the broad market indices expand faster than the economy and generate returns above the inflation rate. Although exchange-traded funds or ETFs have only recently gained popularity in India, they make up a significant percentage of the S&P 500 in the United States. Over the long term, ETFs have always done better than inflation and given their investors a lot of money back. Number 4. Gold. Gold has always been the go-to investment vehicle for Indians since it does not require any knowledge of the stock market. Gold is an insurance policy against the cyclical volatility of financial markets. It has a good reputation as a reliable inflation hedge because its price and return increases have always been enough to keep up with inflation. When prices rise steadily, investors seek the safety of gold. In the financial world, gold has no place. It is a commodity. Research by the World Gold Council found that for every 1% increase in inflation, gold demand rises by 2.6%. Number 5. Gold Exchange Traded Funds or Gold ETFs. Gold Exchange Traded Funds or ETFs are open-ended mutual funds that track the changing price of gold to give investors access to the gold market. It is not profitable to own real gold, and high costs are associated with producing it. In the long run, investments in gold exchange traded funds or ETFs have done better than the inflation rate in the past. Number 6. Real estate. Even though real estate investments in India have grown faster than inflation, they often require a large initial investment of tens of thousands of rupees or more. Generally, the interest on mortgage loans must be included in an investor's financial statements. Real estate often gives a better return than inflation because its value is based on where it is. The average return on real estate investment over the last decade has been roughly 11.6% as measured by the RBI's House Price Index, which compiles real estate prices in 10 cities. For the whole nation, this is the typical rate of return. Because property values vary from place to place, returns may be different from one city to the next. Number 7. Real Estate Investment Trusts or REITs. Real estate investment trusts are a good choice for people who want to diversify their portfolios but can't afford to make a significant initial investment. Institutional investors specializing in real estate are called real estate investment trusts. It's a portfolio of properties that returns money to investors regularly. With inflation, the cost of buying a home and the income from renting it goes up. When prices go up, REITs are worth more to investors because they can raise rents and share the extra money. The demand for alternative high-yield assets might hurt REIT prices. Generally speaking, the demand for treasury securities increases when interest rates rise. Because of this, investors may shy away from purchasing shares of real estate investment trusts, bringing down their prices. A further cost that REITs must bear is the payment of property taxes. Number 8. Investing in inflation-indexed bonds. Bonds whose values increase as inflation increases are a safe and reliable way to protect against rising prices. The RBI is responsible for the issuance of several kinds of bonds for the government, including inflation-indexed bonds. The updated principal amount is used to figure out the interest, which makes this bond unique because it automatically adjusts to inflation. We'll look at an example to simplify the computation for you. Let's pretend the annual inflation rate is 10%. A bond of 100 rupees that you possess accrues interest at 8% per year. A common bond's end-of-year interest payment would be 8 rupees, while an inflation-indexed bond's end-of-year interest payment would be 8.8 due to the bond's principal being 110 rupees after inflation adjustment. Other investment options, vintage automobiles, and works of art are two examples of physical assets that may be used as a hedge against inflation. It is expected that the prices and values of these collectibles will go up over time, giving higher returns than inflation. On the other hand, they are very risky and will cause trust problems. Investing in hedge funds or startup companies through unlisted shares is one way to fight inflation. But it would be best if you only judged them based on how much risk you're willing to take and how much you want your investments to earn. To rebalance a portfolio. Portfolio rebalancing is the adjustment of a portfolio's asset allocation in light of changes in the market over the long term. Many reasons, like fluctuating inflation rates and changes in financial goals, might call for a portfolio to be rebalanced. You shouldn't expect your 2012 portfolio, which took into account the economy and inflation rates, to continue to serve you well in 2022. So, one way to protect your savings from inflation is to review your holdings periodically and make adjustments only when needed. Doing it the right way. This exposure to the stock market must be handled properly. Use a mix of active and passive mutual funds instead of randomly buying stocks or an index of stocks. Finding the right companies to invest in and knowing when to cash out may be challenging for investors. At first glance, back-tested stock portfolios seem like a good idea. However, the long-term viability and the likelihood that an investor will regularly rebalance their holdings are very questionable. In addition, ongoing tax increases are necessary to fund this re-equilibration. The adage, "choose the proper fund and stay invested," rings true. Combining large cap index funds with flexible cap and mid cap funds is a good strategy. Your actions greatly help inflation resistance in your investments. Poor returns come from trading too much, which includes keeping an eye on prices all the time and selling at the first sign of trouble in the market. Carefully consider the potential consequences. Cryptocurrencies, peer-to-peer lending, covered bonds, and similar investments may offer good returns, but they also come with many risks. You cannot risk losing money only to beat inflation. Consider the National Pension Scheme if you want your retirement savings to grow over time without inflation eroding them. Since the NPS is a market-linked product, many people have a skepticism about it. But the equity component might make it easier to build up more money. Assuming a 6% annual return on a monthly investment of 10,000 rupees in the NPS for the following 30 years in corporate bonds yield 10 lakh rupees, whereas the same 10,000 invested in the active equity option yields 2.26 lakh rupees. What works well for NPS is the combination of the active stock option and being forced to invest in a disciplined way. A reasonable savings rate is essential to a sound financial plan, but making smart choices is also very important. The implication is a decrease in discretionary spending. You may need to reevaluate or revise your monthly budget. The goal should be to save and invest 30 to 40% of the after-tax income and keep the EMIs to no more than 30% of the revenue. This was all from Omega Finance to guide on how to beat inflation by investing in stocks. Long-term inflation has far-reaching effects on people and society as a whole. Until next time, please subscribe to this channel and press the bell icon to get the latest updates from this channel.